The Euro's rally is running out of puff, choking once again today on a surprise fall in German investor sentiment. I'm Jamie McGeever and this is today's Market Pulse. Joining me here in the studio is Reuters FX analyst Neil Kimberley. Neil, that Ifo number was surprisingly weak, down for the fifth month in a row, and we've also got Germany now pouring cold water on the leveraged €2 trillion ESM rescue fund. How far on the downside can we go on the euro?
Well, you've got the 200-day moving average lower down, Jamie.
128.27.
Exactly. That would be, for me, the initial target. What interests me, though, is despite the fact that people like myself and other people in the market who are quite cynical about the Eurozone situation, you alluded to the two German factors this morning. We also have renewed question marks over Greece's ability to meet its requirements. We also have the Spanish basically treading water, keeping us all dangling but not accepting. If you want a reason to sell the euro, it's there, and yet we're still here at 129.05 as we're coming on air. You do get the impression, and I'm also hearing, by the way, very strong bids around 129.80. So
128.80.
Yeah, 128.80. That should be out there. You do get the impression that the wider market has taken the view that nothing horrible will be allowed to happen in the Eurozone before the US presidential election, and consequently they're happy now to pick them up on dips and sell them up on any little rallies.
That's 6 weeks or so of treading water. That's not going to happen, is it?
No, I personally don't think it's going to happen, but that doesn't mean to say that the market doesn't think it at the moment. You know, it may well be wishful thinking, but you do get the impression that whatever you throw at the euro at the moment, it's Teflon. Nothing sticks to it, and it keeps finding a little base and then bouncing back 100 points.
What about market positioning? We had the CFTC data, obviously after the close here in Europe on Friday, shows that speculators are now holding their smallest net short euro position in almost a year.
Yes, so they've trimmed back. I mean, it's still a very significant position, but nevertheless they've trimmed back, and that tells me at the moment they have the capacity to go back in if they so desire. And that's the difference. You don't feel the market is massively overextended. Also, Jamie, anecdotally towards the end of last week, there was a lot of talk in the interbank market about big macros unwinding long euro positions taken after the FOMC. Now, at best, those guys probably got out flat. At worst, they took a hit. But the fact is, a lot of that positioning was taken off, which gives them the opportunity to buy back again if they so desire. And that's where we are. You buy the dip, you sell the rally, but you don't really think it's going massively one way or the other.
So what range are we talking about here?
Well, you alluded to the 200-day moving average, 128.27, I think you said. That area down there, 128 figure 30, looks pretty well bid, and it looks very heavy above 131. Now, that's not much use to anybody who's sitting there watching this go, oh, Neil, it's 129.05 in a minute. What do I do? Well, frankly, you keep your powder dry. You play the ranges. There's no point being a hero in this because, frankly, nobody really knows which way it's going to go next, so they play a tight range.
Okay, we've spoken about the positioning from the macro and the funds and spec community. What about European corporates? You think that demand for euros from those big exporters in the Eurozone is drying up?
Well, this feeds my minority view that the euro should be lower. The real world perhaps begins to intrude because obviously euro demand for hedging purposes by Eurozone exporters is always a central pillar of euro support. But I don't think it's there at the moment. I think you'll find, and I'm discussing with corporates and they're telling me, sales forecasts are being tweaked lower. Now, we know where the euro was earlier in the year and we know a lot of hedging was done. I believe myself that a lot of major Eurozone exporters are fully hedged now into the end of 2012 at best. At worst, they might be overhedged, which would mean they could actually conceivably have to sell some euros. I don't think we're there, but I think we are in a position where they sit back and say, you know what, I don't have to buy any euros at the moment. And I think sales guys at major banks around London and the continent who talk to the Eurozone corporates will be able to see where I'm coming from that because they must have seen the decline in volumes recently.
Let's finish up with corporate activity from Japan, and we'll talk about euro yen. Surely, being the last week of the half, the fiscal year and the half fiscal year in Japan, surely we'll see more corporate activity from Japanese.
You would expect to see some. You must remember last year, everybody hung on till the end of September, hoping that the Bank of Japan was going to bail them out. It didn't happen. This year, they've been more proactive. Euro yen is a case in point here. Budget rates around 100. For 3 days last week, it was above 103. That gave Japanese exporters ample opportunity to do their hedging at a good rate ahead of the financial half-year end. If you didn't do it, you shouldn't be there, frankly. Now we're back down around 170 as we're coming on air. Yes, there are big stop losses below 99.80. Yes, it gets very ugly down there, but there isn't a necessity, as far as I can tell, for Japanese exporters to come to market aggressively between now and the end of this week. Rather, I think they may do minimal operational requirements at the Tokyo fixing every day, and it will all be absorbed into the pot.
OK, Neil, thanks very much. We'll continue this another day. Neil, thank you very much. That's all for now. My thanks there to Reuters FX analyst Neil Kimberley. There's more on Reuters.com and inside our platform, of course, and find Market Pulse every weekday at noon London time for your snapshot of what's moving on markets and why. I'm Jamie McGeever. This is Reuters.